So when you're a business entity type as a sole proprietor or a single member disregarded entity LLC, when you bring in income and you pay your business expenses, you have profit. That profit is taxed on your personal return. It's all subject to self-employment tax. And basically whatever that profit is what you're taxed on. If you have a business account, which would be advisable, when you take money out, that's called a draw. And you can take money out anytime you want. Just make sure you set aside 50% for tax. I know that sounds high, but 50% is a good round number. You'll never get in tax trouble if you do that. The next entity type is a partnership. It's basically the same. A partnership, general partnership, or an LLC partnership. It's the same concept as being a single member LLC or self-employed, as the rules are the same. It's just that we have to file a separate tax return to produce the tax document that's your K-1 that shows your share of the profits, and you're going to take draws as well, and you're going to set aside money for taxes. When it comes to a C Corp, that is a whole separate entity, and the corporation pays all the tax. You don't pay any tax. Corporation pays tax on the profits. The corporation is going to pay you probably a wage or dividends. Those things are taxed to you, but the corporation pays the income tax. The S Corp is kind of a hybrid between a C Corp and a partnership. It's a flow-through entity, meaning the S Corp does not pay any tax other than city income tax, but all the profits flow through down to the individual shareholders. The S Corp pays its shareholders in two ways. One is it's paid by their reasonable compensation, which is their payroll. The other way that it pays them is the profit distributions. So if the company makes $50,000, the S Corp can pay the owner, the shareholder, $50,000. That $50,000 is still taxed, but it's taxed on the individual shareholder's tax return. It's not taxed at the company level, it's taxed on individual shareholders level. So what we try to do is, knowing that there's this 50% tax rate, if a company makes $100,000 in profit, for simplicity purposes, we would say we'd give the owner a $50,000 a year salary, and we would withhold taxes and retirement and do all those things on the salary. And then the $50,000 of profit, we would distribute that to the client, to the owner, and they can spend that however they want. That way we know they have reasonable comp, the retirement's covered, their taxes are paid, and they know exactly what they can spend at home.